So, does it benefit you to get a worse credit score to purchase a home? I mean, that's the headlines. The headlines is that why bother improving your credit score? Why bother spending all that time, money, and energy to getting the best credit score to get the best interest rate, especially with Biden's most recent changes? Now, I will say Sandra Thompson had more to do with this than Biden. This was an FHFA push to support those who have lower incomes and lower credit, typically minority buyers who don't have as much access to home ownership historically. FHA has done a better job of that. With the fact that if you have a lower credit score and you have some bumps and bruises on your credit and less money down, you actually get a better interest rate than you do conventional, even with these new changes. FHA is still going to be the best solution for that specific criteria. But let's talk about exactly what changed, because there was a lot of headline news over this last week, and the timing is kind of old news, if I were to be honest. I mean, it's going live May 1st. But this was announced back in March. In fact, we talked about it several times during our Thursday market update. So I pulled out some of those old slides. I was like, yeah, there was. But it didn't go live until May 1st. So why all the hype today? So mortgage lenders, let me just say that mortgage lenders already have these changes baked in. It's not as if interest rates on May 1st are going to change. They've already changed. And here's why. Fannie Mae and Freddie Mac put out this rule back in late February, in March, saying that they were going to require that this new LLPA grid, which I'm going to explain in just a second, this new LLPA grid was going into effect on all loans submitted to Fannie Mae and Freddie Mac as of May 1st. Now, I can't, as an applicant who wants to buy a home, I can't apply for a loan, get under contract, close, and have that loan insured by Fannie Mae and Freddie Mac in a day. It takes 15, 30, 45 days to get a loan closed. 8 days if you're pre-approved with the Rueth team. But it takes time. So lenders have been merging these changes in based on their lock dates. So those with new construction or 60, 90, 120, 360 day locks, longer locks, have already had these baked in. Those with shorter locks got them baked in throughout March and at the very beginning of April. And by the time the beginning of April came around, pretty much everybody had these changes already in all of their loans. So your rate's not changing on May 1st. Let's just start there. So let's talk about the LLPA specifically, because it really affects conventional loans. At the same time, Fannie Mae and Freddie Mac announced their changes to their LLPA structure, probably the biggest change of its kind. FHA and VA announced their changes to the positive. FHA, if you remember, dropped their monthly mortgage insurance by 30 bips. That was a massive savings. The Rueth team sent out a chart showing what that savings would be on a monthly basis to every borrower. VA dropped their guarantee fee by 15 bips, dropping the amount that a veteran has to pay at the time of closing because VA doesn't have a monthly mortgage insurance. We sent out that grid as well. Happy to resend. Jumbo loans follow conventional in that they have LLPAs, but they have LLPAs designated by the jumbo lender. So they're not all going to flow to a jumbo loan. Whether you're talking about an aggregator like Redwood or one of the primary aggregators or one of the primary ones like a Chase or Wells Fargo, they will follow their own banking guidelines for risk tolerance. That's all an LLPA is. It's a guideline to adjust the interest rate for the rate tolerance. So now that we know that LLPA's loan level price adjustments are really only impacting conventional loans, in this manner, right? Fannie Mae and Freddie Mac. Let's dive deeper into what that means. So a loan level price adjustment is that adjuster for the specifics of the loan. That's why when people call up and say, "What's your rate?" my answer is, it depends. It depends. Because there's a chart that will lie out what your credit score is, how much you're putting down, what you're buying. Is it a condo or is it a single family? Or is it an attached versus a detached that affects rates? And then one of the changes that were implemented was now debt to income ratio is going to impact the LLPAs. Now that change, that specific change, was pushed out. So we're going to revisit the debt to income ratio nuance of the LLPA changes in the fall. So if you have a high debt to income ratio, it's going to impact you and give you not a lower credit score. It's going to give you a higher interest rate. That's something that you're going to want to get in front of. All of these things you want to get in front of. You always want to give yourself the position of getting the best interest rate. But it's not as simply as getting the highest credit score. It's also about managing how much money you're putting down and eventually your debt to income ratio. So a loan level price adjustment takes the market rate for 30-year fixeds and it adjusts it based on these criteria. So we talk a lot in our market updates about the 10-year Treasury yield. The 10-year Treasury yield is a public bond that you can buy and sell. It's bought and sold on the open market. And the 30-year fixed interest rate, mortgage interest rate, typically follows the 10-year Treasury yield. Now, if I did that and I said, okay, well, the 10-year Treasury yield is 3.5, then the 30-year fixed, right now, it's a 3% spread. Historically, it's 1.65. But right now, given the risk in the market, in the financial markets, it's 3. So if the 10-year Treasury yield is 3.5, then the 30-year fix should be 6.5. I mean, just big swipe, right? So if somebody says, "What's your rate?" I'm going to say 6.5 because the 10-year Treasury yield and the 30-year fix is running at a 3% split. But that's not your rate. Your rate is based also on the LLPAs, the loan level price adjustments. So we put together a grid, and I posted this on Facebook, and you can scroll down just a little bit, and you can see the T-chart in the grid that we posted on Facebook on Saturday, talking about what was the shift or changes from the old LLPAs to the new LLPAs. And remember, I talked about this at the end of February and again in the beginning of March because it was going to be assessed starting May 1st. That T-chart showed that the red, the most effective in a negative way zone, was the higher credit score, more money down. Not most money down, but right there at that 15 to 20% down, 680 to 740 credit score. They also implemented a new 760 credit score. The top tier used to be 740, now it's 760. So that red bar, everybody, and the news was all talking about the fact that it's better to get a lower credit score to get a better interest rate. But that's not true. I mean, that's not how the model works. This was just the changes to the model most impacted those who were putting 15 to 20% down and had that credit score between 680 and 740. Now, we also talked about a hack that you could do, and it's a real hack, and it does work, especially if you're a first-time home buyer and you're putting 3% down. If you have a good credit score, and if you look at the chart, you'll have less of an adjuster, meaning you'll have a more true-to-market interest rate, a lower interest rate, if you put less money down. If I follow the same line, it's an interest, or I put more money down. I can either jump to 30% down or I'm putting 3 to 5% down. But because I have the ability to put 15 to 20% down, my credit score got impacted the most. Now, if I put the least amount down, I might have an interest rate a quarter to 3/8 better, possibly. And if that's the case, and I tack on mortgage insurance, but I have the money, I can simply get that loan with 3 to 5% down. And after I make one mortgage payment, I can do a recast, meaning I pay that additional principal balance, drop my loan to value to the 80% where I can get rid of mortgage insurance and have that lower monthly payment. And because Movement Mortgage, we service all of our loans, we can do that very swiftly after only one mortgage payment. But there's a hassle factor involved. You have to determine what's your worth in time. Do I want to deal with that? Do I want to sit aside? Do I want to try and do a hack? Or do I simply want to buy a home? And then do I know that interest rates are probably going to be going down? Because if you watch the news at all, we are already starting to see consumer spending is slowing. We talk about it every Thursday as well. We're starting to see the slower economy. We're starting to head into a recession. What that will look like, we don't know. We're seeing more layoffs. As we see that, the back half of this year, the first half of 2024, we're going to see lower interest rates. With lower inflation comes lower interest rates. You'll have the ability to refinance. So do you just take the rate that you've got, know that your monthly payment is what you need it to be, know that you put the money down that you need, and that you'll refinance it in the next 6 to 12 months? Now, it's not true that if you drop your credit score and if you go get a medical collection or if you rack up your bills, you're going to get a better interest rate. Because more than likely at those lower credit scores, your better interest rate is FHA. And we know the one downside. I love FHA loans. They are a phenomenal loan, and especially since we know people can refinance out of them into a conventional once they build up enough equity. You've got to know that with an FHA loan, you have lifetime mortgage insurance until which time you refinance. Those lower credit scores are still going to be better suited for an FHA loan. We are going to post the grid in our comments below that that specifically shows what the LLPAs are for the down payment and the credit score. And what you will see is that with these most recent changes, that the people that had the most money down and the highest credit score, yes, they did have the biggest negative adjustment. And those people at the bottom of the chart that had the lowest credit scores and maybe even the least money down, they had the best adjustment. It actually got better. But when you land at the final chart, those who have the lowest credit scores still are paying the most in LLPAs. That did not change. What they did was they started to crunch the entire chart so that it was more in line without a big spread between. So the people that had the best credit scores got worse, the people with the worst credit scores got a little better, and we still have this same parallel in a relationship where if you have the worst credit score, you're going to have a lower interest rate. Now, if you have the lowest credit score and you're putting the least amount down, interestingly enough, you're going to have a better interest rate than if you have a lower credit score and you're putting 20% down. Again, so much of mortgage lending isn't transactional. It's strategic. This is why we lean in and want you to work with not only a local lender, but a lender that believes in the strategy behind the science, that believes that there's the strategy to help you build real wealth, to get your feet in the door into home ownership and take advantage of, yes, these changes and all the changes that are yet to come. I know the intentions were good. The execution left a lot of people scratching their head. Nicole Rueth with the Rueth team. I hope you guys are having a fantastic rest of your day. Reach out to us. We'd love to go through your scenario. Not the rate, but your rate. Talk to you guys soon.